Real estate has always been considered the safest path to wealth, but the world has changed. Interest rates, housing shortages, inflation, government policies, and global uncertainty have created a new reality. So the big question is real estate still worth it in 2026? Or is it finally time to look somewhere else? Let's break it down. For decades, real estate followed a simple formula: cheap loans, buy property, price goes up, cash flow, or sell for profit. But today, the formula isn't that simple. In many countries, prices are high, rents are regulated, mortgages are expensive, taxes on investors increased. More competition, less supply. Governments add stricter rules. What used to be easy money is now a calculated strategy, not a guarantee. But this doesn't mean real estate is dead. It just means you need to understand the new rules. Interest rates are the #1 factor determining whether real estate makes sense. High interest rates mean higher monthly payments, lower cash flow, tougher approval, decreased affordability for buyers. But here's the twist. High interest rates also crush buyer demand, which slows down price growth or even creates small corrections. This opens opportunities. Less bidding wars, more negotiable sellers, better deals if you're patient. And when interest rates eventually drop, your expensive mortgage suddenly becomes a cheap mortgage, and you bought the property at a lower price. Real estate investors call this marry the property, date the rate. You can always refinance later. People have been predicting a real estate crash for 10 years. But here's the uncomfortable truth. A true crash is unlikely in 2026 for one reason. Supply cannot keep up with demand. People still need housing rentals, starter homes, family homes, affordable apartments. Immigration stays high, construction stays slow, building costs rise, land is limited. This creates a situation where prices may cool down, but not collapse. So the question becomes not will prices drop, but will prices drop enough to make real estate a bad investment? Right now, the answer is probably not. If you're buying real estate as an investment, the key number is cash flow. Can the rental income cover your mortgage, property tax, insurance, maintenance, vacancy, repairs, management fees? In 2026, rents are still rising in most major cities because supply is tight. Even with tighter regulations, housing demand is strong. This means cash flow is possible, but only if you buy the right property. Good rental areas share these traits: population growth, job opportunities, low supply, high renter demand, reasonable purchase prices. Bad rental areas have declining population, high unemployment, oversupply, expensive purchase prices compared to rent, strict regulations. In 2026, choosing the right location matters more than ever. Governments worldwide are tightening rental rules to protect tenants. These include rent caps, stricter eviction rules, mandatory energy upgrades, higher taxes on investment property, increased stamp duties. Is this bad for investors? Yes and no. Yes, because regulations make some deals less profitable. Cash flow becomes tighter, expenses rise. But also no, because regulations push weak investors out. Fewer investors, less competition. Housing shortages increase rent demand, strong operators survive and profit. If you understand the rules and budget correctly, you can still win, while inexperienced investors quit the game. In the past, investors relied on appreciation, the property going up in value. Today, appreciation is slower and less predictable. That's why in 2026, the focus shifts from appreciation to cash flow and fundamentals. Ask yourself, does the property cash flow from day one? Is it in a growing area? Is it needed by the market? Does the rent realistically cover all costs? If your answer is yes, the property will likely stay profitable regardless of short-term price movements. Even with higher interest rates and stricter rules, real estate is still one of the best wealth-building vehicles. Here's why. 1. Leverage. You can buy a $300,000 property with $30,000 of your own money. That's powerful, and no stock market investment allows this safely. Over time, tenants pay down your debt. Even 2 to 3% per year adds up massively over decades. In many countries, you can deduct Interest expenses, depreciation, renovations, maintenance. As prices rise, rent rises. Your mortgage payment stays fixed. Real estate is one of the few assets that becomes more valuable during inflation. Real estate is not a good investment. If you buy with emotion, you rely only on appreciation, you stretch your budget, the numbers don't work, you ignore maintenance costs, you buy in a declining area, you don't have emergency funds, you underestimate repairs, you think it's passive income. Real estate is a business. If you're not ready to run a business, real estate becomes a nightmare. If you want real estate to work in 2026, follow these principles. 1. Buy below market value when possible. Look for distressed sellers, off-market deals, properties that need light renovation. 2. Focus on cash flow, not hype. If it doesn't cash flow today, skip it. 3. Buy in economically strong areas, jobs and renters, growth, appreciation. 4. Play the long game. Hold for 10 to 20 years. Ride out cycles. 5. Prepare for repairs and vacancy, budget realistically. Expect surprises. 6. Don't over-leverage. Keep a safe financial buffer. 7. Consider alternative real estate investments. You don't always need to buy a property. There are other options. REITs, real estate crowdfunding, syndications, fractional property investing. These give exposure without the hassle of being a landlord. The honest answer, yes. Real estate can still be an incredible investment in 2026, but only if you play by the new rules. It's no longer about buying anything, waiting for prices to rise, relying on cheap mortgages. It's about cash flow, smart analysis, good locations, patience, solid financial planning, long-term thinking. If you apply these principles, real estate can still build life-changing wealth, even in a more difficult market. But if you treat real estate like a lottery ticket, you're going to lose money. Thanks for watching. And if you want a full breakdown on how to find profitable properties in 2026, comment below and I'll make that next.